Hello, fellow traders. Steve Ganz here with another in the Compare and Contrast series. So I think this should largely wrap up the comparison of all different types of butterflies to other butterfly trades, like we did a broken wing butterfly compared to a flat butterfly, etc. Today, I'm going to compare a broken wing butterfly. Now, I think if you've watched any of these previously, you know that I tend to prefer the all-put butterflies as opposed to an iron butterfly. Again, just kind of a personal preference thing. It doesn't make a huge amount of difference, and if you're not sure about that, go back and look at the Compare and Contrast series where I compare an iron butterfly to an all-put butterfly. But for today, we are going to compare a put broken wing butterfly against a put broken wing condor. So they're very similar trades. You probably have picked up, again, if you've watched any of these, that they're essentially the same trade. All that is different in both cases, we buy a long put, then we're selling two short puts, and then we're buying a higher long put. So this is the case for the condor right here. That's what that looks like. The exact same thing is true of the butterfly, with the exception of these two short puts. The two that we're selling are at the exact same strike. So you can see this says ×2 here. So that's the only real difference. A condor and a butterfly are essentially the exact same trade. It's just all about where those short puts are at. So what I've done in this comparison is I've attempted to set these two up fairly close to the same level. And what I mean by that is I'm trying to make both of them about the same distance either side of the current market. The current market, and again, I like to show all of these examples in SPX, and we're at, call it 4370 here today. So I want 4370 to kind of be in the center of my tent, if we want to call it that. So over here, you can see I'm pegged exactly in the center of the tent. Over here, I'm pretty close to being the center of the tent. Again, it's just that this tent, rather than being a teepee, which is nice and tall, this is a flat top tent. So the first thing you'll notice is that it does not have nearly as much profitability in it. So let's just kind of walk through these two. So in both cases, they have comparable max loss. Now, of course, this can all be adjusted simply by moving our strikes around here. I can decide how much risk I want in each one of these trades. My goal right now in looking at these, given that our market has run up as hard as it's run up, and given that it may continue to run up, I don't really want to put on a trade right now that has much upside risk. We seem to be back in a very bullish mode. I don't personally understand why we're as bullish as we are, but we are. So we got to take what the market gives us. So I don't really want to put on anything that's going to get hurt to the upside. So that's why these are configured in the way that they are configured. That's why I chose to do this broken wing series here today. So anyhow, in both of these cases, you'll see that if the market were to rip up, we would not lose money to the upside. Now we can also see that by looking at our break even here. You can see rather than two break evens, we only have one break even. That one break even is right down here. And likewise, right down here. Okay, so we don't have an upper break even because there isn't an upper break even. We're always going to be profitable to the upside, which again is why I've structured these two trades in the way I've structured them. So I've tried to make them about an equal amount of risk, and I've tried to center our current price under their tents, whatever their respective tents might be, and I've tried to set them up so that they have no upside risk. So again, once I try to get all of those things rolled out together, these are the two configurations that I'm looking at. So on the one side, you can see that we do have a potential max loss if the market were to totally tank of 1930. Over here, we're 2350. So again, they're pretty close in size. This one's going to have a net credit going on of $60, $70. This one's going to be about 130. Where we're going to differ quite a bit is our max profit. So this one has a max profit of 1,060, 1,050. This one has a max profit of 3,650. However, it's very important to note that here I just need to expire anywhere between this, call it 43.30 up to 40, what are we at, 44.10. If I expire anywhere in that window, I am hitting my max profit of $1,070. Over here, I have to peg the center of this tent in order to get that max profit. So that's the difference between these two, is this one, while it has a much lower peak in it, it has a much wider range. We can see here that our break even is down here at 43.19, where over here our break even is 43.33. So we've got a little more room to the downside over here, and we have a lot more room to the upside. We can come all the way up here to 44.20, and well, let's call it right here in order to be at peak profit at that 44.10. Here, at 44.10, we're back down to basically the minimal upside profit we can get. So in these trades, the goal is to try to figure out, do you want a wide range on your tent with a lower peak profit, or are you looking to have this higher level of peak profit? So our chance of profit is very similar in both of these, 62%, 59%. Now, let's take a look at the Greeks. Okay, so in looking at these Greeks, probably the most important Greek to me is going to be the theta. And theta is very, very similar in both of these as well. Theta is the amount of decay that happens on a daily basis in these trades. And then the other one would be delta. In other words, how much is this going to be impacted by an up move or a down move in our market? Now we can see that this one has a little bit higher delta. It's going to be impacted a little bit more. In an up move, it's going to show a little more profit faster. In a down move, it's going to give back a little bit faster. So it's just going to be slightly more maybe volatile, or directional is probably a better word. But it's slight. It's just, you're about 1 point difference in delta. So that's really what we're looking at. And we can see that if we come in and we bring our expiration back, we bring this all the way back to today, and we do that on both of these. You can kind of see that between these two. So we're a little bit, our line slopes down a little bit steeper or a little bit faster here on this one. Now I'm looking at the dashed line is probably the easier one to look at, but you could look at either one of them. And so that's really all that means in this particular case, is that one of them has a slightly more bullish tilt. The one with a little more positive delta has a slightly more bullish tilt, but again, not significant by any stretch of the imagination. So that is largely the difference between these two when I configure them as close to kind of the same as I can. Again, keep in mind with any option trade, that's the beauty of options trading, is I can configure these to place my risk and reward wherever I want it to be. If I have an opinion, for example, that right now maybe our markets are overbought and I don't think we're going to continue to go higher, I may not want positive delta. Well, if I don't want positive delta, I can do something like this, where I widen out my wings on the upper side here, and now you can see that takes me back not quite to negative delta, but to a little more neutral delta. But if I do now continue to get that big upside move, I could potentially lose money on the upside. Again, and of course I can do the same thing over here in much the same manner. And now I've moved this one all the way to a little bit of negative delta. So now this thing is set up in a way that it's going to profit a little bit more if the market pulls back. I can of course do the same thing over here by just simply widening this out. Now I've moved this one to negative delta. So let's just real quickly, to wrap this up, let's move both of these to flat flies where I have the same amount of risk on both sides. Let's again go and move these back to today so that we can see how our T0 lines would move. And look at that. Look what happens to those. Now, if the market falls, these are both making money in a market drop. Again, that is because we are now negative delta. So I know I tossed kind of a lot at you there, but the main takeaway for me in looking at these two different structures is how wide of a range do I want to have, do I want to allow for my position? And again, if I have an opinion that the market is in a pretty bullish mode right now, and I don't want to, be encumbered or lose money if the market continues ripping up, then this is the structure that I want to be in. Again, if I have that bullish opinion, and again, we're back to positive delta there. So hopefully that gave you a fairly decent sense of these two. I will, again, as I usually do, save both of these trades. And I would urge you to put them on in paper in your account as well, and just watch how these things develop over time. And I should also say, we have, just kind of as a wrap up, we do have the one trade in our start to finish program. And I did get some comments on that where people were saying, shouldn't we be checking in on that every day? Well, let me come in and I'll pull that up here real quick and let me just discuss that. Let's see. I should save that as a new trade. And then, I need to come here to my saved trades. Let's see. Let me find that one real quickly. And I believe it was this one right here. So let's view that. Yep, that's it. So on this particular trade, the question was asked, well, shouldn't we be looking in on this every day? This is a long-term trade. This trade is all the way out. We put this on the 7th. This doesn't expire until July 21st. So there's a lot of time left in this trade. And this is the way that I trade and that I teach students to trade. I want to trade in a way where I don't have to be sitting at my screen. I might only look in on this position maybe once a day, maybe once every other day. And at some point, a week or two in, I might need to make a small adjustment to this. So sometime later this week, if our market stays up here where it is today, yes, I might need to do some sort of adjustment. But right now, this is kind of where that trade is at. It's up in here somewhere. It might be off just a little bit profitability-wise. Yeah, it's down $95. But nothing to worry about. Fed announcement tomorrow. We may get a pullback. If we don't, then yes, I will need to be adjusting this trade later this week, and I will do that in the start to finish series. So everyone, that is it for now. Thank you so much, and happy trading.